Ah, we are now live.
Everybody can hear us, Simon. Good evening, sir.
Good evening.
Good evening, Mr. Tripathi. How are you, sir?
Good evening. I'm absolutely fine, sir.
Good, good. Nice to see you.
Yes.
Great, sir. So we have, we have so far about 21 participants joined, sir. We'll give another 2-3 minutes for everybody.
Sure.
And then
Sure. What are this?
How are you holding up in Mumbai, sir? I hope all is well.
No, we're absolutely fine.
Good.
Yes.
Thanks.
very good evening, everyone, and welcome to the Marsh India and Carpenter India Crop Insurance Market Update. We are awaiting a few participants to join us, so we will be starting in the next 2 minutes. Thanks for your patience. A very good evening to you all, and welcome to the India Crop Insurance Market Update from Marsh and Carpenter. Thanks for attending this virtual event and making time to attend this session. We hope you find this engaging. Some housekeeping rules before we start. As we are on a Zoom platform, your lines are muted. But if you wish to ask us any question while the session is on, please feel free to type in your question in the Q&A tab, which is at the bottom panel of Zoom. We will also be running a poll and request your active participation to make this session more interesting. We have amongst us Mr. S. Tripathi. Sir is the General Manager at GIC Re. He handles agriculture, all specialty lines in reinsurance, excluding life, health, and marine, investor relations, credit rating, investment accounts, innovation center, HR, and a whole lot of other portfolios as well. We request Sir to share his views on the Indian crop market in 2020, the role GIC Re as a leader in the market has played in lending a certain credibility and sustainability to the market, and how he views the upcoming Indian renewals for the benefit of all the cross border reinsurers and the onshore reinsurers who are present with us today. Over to you, sir.
Thank you, Lindsay. Good afternoon, everyone. It is my privilege to deliver the keynote address for this August audience on the Indian crop insurance market update. As you are all aware, the Indian crop insurance market took a giant leap forward in the summer of 2016 when the Prime Minister's Fasal Bima Yojana was launched. The scheme actually moved over to an actuarial regime from that day. And as we speak now, we have almost completed 5 years on this scheme. The experience that we have harnessed from these 5 years are immense. GIC was anyways involved in the various schemes of crop insurance that was implemented in India since 1985. But there has been a sea change in its operation and the ecosystem through which we are operating right now. At present, if we look into the season that has gone by, that is the summer of 2020, despite the pandemic, the agricultural practices have been absolutely top-notch in the country. There have been full support from the provincial governments and the central government to conduct all the practices that are required for a successful crop season that has gone through. We had a very good monsoon this year also. So all taken together, we expect that the year 2021, including the ongoing winter season, should lead us to an overall Indian market of around 4 billion USD. A little bit up and down is also possible. Of this, the summer season would have actually seen close to 3 billion, and we should be having around slightly more than 1 billion for the winter crop. And the winter premium is largely from the state of Tamil Nadu for the monoline crop of paddy. GIC has given immense support to the scheme from day one when the scheme was launched. We have been participating and giving capacity to almost 45 to 50% of the overall market since those days. And it is for the first time during this Kharif, that is the summer of 2020, we have reduced our overall exposure from around 46% to 34%, including the 5% obligatory that we have. But other reinsurers have stepped in and have seen to it that there is no dearth of capacity in the Indian market. We have also seen during these 4 to 5 years that the premium rates have come to a point where we can tell that they have become stable, more or less. There have been some volatility in the overall weighted average price for the whole country. But for this year onwards, I believe that most of the underwriters have understood the vagaries of the scheme and where they need to give more resources, where the pricing has to hold, and where they need a little bit of loading depending on the risk factors for that particular cluster. As we talk now, this is one of the seasons that has gone by, has also seen a significant amount of interest in the facultative side of the crop insurance also because of the slightly deviation from the existing PMFBY. Two of the states, that is MP and Tamil Nadu, have opted for a slightly different scheme within the ambit of PMFBY, where the states have stepped forward to have a sharing in the overall risk and the premium also, including a refund of premium if the loss ratio is below a particular level. We expect that this is an experimentation that is going on, will be there for a year or two, after which majority of the states will be remaining within the ambit of the PMFBY, and we will see more normalization of premium going ahead with the current PMFBY and the deviation from the PMFBY, that is the schemes that are there in the other states also. Our discussions with the state governments and the central governments also lead to a point that most of them have concerns on the premium rate, and that is one reason for which many of the states wish to have a different set of parameters for their state. The concern is because of the increase in the premium during the last 2 to 3 years, and this increase has come because of poor understanding of the yield data and the variation of yield data, the dichotomy of the various crops that are there in most of the states, and the moral hazard involved in the conducting the crop cutting experiments. Central government has been very proactive in going towards a stage where the crop cutting experiments and the yield estimation coming out of that will be purely through a scientific measurement method, and will be totally ruling out the physical crop cutting experiments that are being conducted in large numbers today. We see a much brighter future for crop insurance in India, and we expect that the market will steadily grow, and from the $4 billion which is there this year. And we have to understand that this year, for the first time, the scheme was notified that it was not compulsory for farmers and it was made voluntary. Despite that, and despite the pandemic ruling across the country, there was no fall in the overall premium for the country, including some states having gone out also. So we see that the coverage of areas are likely to increase in the future, in the intermediate and in the long term also. The practices that are being followed will be reinforced with implementation of scientific procedures and satellite-based images for assessment of the yield at the end of a season. And more states will be participating in the PMFI in one form or the other. GIC will continue to play a dominant role in giving capacity to the market, and at no point of time we will be going out of the scene as a whole. We will definitely be there, and we will be providing support to the cedants that are implementing the scheme in this country, and we'll see to it that the PMFPY on a long-term basis is sustainable, has an optimum price for all stakeholders, and will be going a long way in providing necessary relief to the farmers in a country which is more or less ravaged by natural calamities every year or the other. This is exactly what I had to give before you, and we expect that after 3 to 4 decades of crop insurance being launched in this country, we are looking forward to a bright future ahead, and it is our fervent hope that almost all the reinsurers who are present in the market will continue to remain there, and GIC will play always a pivotal role in the implementation of the scheme ahead. Thank you very much. I thank the management of Marsh and GC for providing me this opportunity to give you this update about the Indian crop insurance market. Thank you very much.
Nymphia, I think you're muted. So thank you so much, sir. And we will start with the India crop market update presentation.
Yeah.
So we are covering majorly the major highlights which within the crop insurance, and then we are going to cover the industry analysis on premium volume, market share, and loss ratios. We have done some analysis on premium rate changes and realized rate analysis. Thereafter, we'll talk about non-loany policies. Then we'll give you the weather update, followed by the loss ratios for Kharif 2020. So as we have seen, This year, we have seen many major changes under the government policy, and there's a revamped premium guideline which has come into picture. We've seen the voluntary provision with voluntary scheme with the opt-out provision. We also saw there were many insurance companies who moved out of the policies. So Royal Sundaram, followed by the other insurance companies, moved out earlier. We saw some of the states moving out this year due to one of the other reasons. We have Andhra Pradesh, Jharkhand, we have Telangana and Gujarat moving out of the policy. We have Maharashtra, which has given a project for 3 years, but then they have revoked the 3-year contract this year as of now. We have West Bengal, which has started BSBY. It's a technological based scheme. We have Madhya Pradesh and Bid moving to SSM model, which is a surplus loss sharing model under the ambit of PMFBY. We have Tamil Nadu moving to a co-insurance model. So this year we've seen bumper sowing and harvesting of all types of food grain crops in Kharif season. And also we have received around 8.74% above normal rainfall in the monsoon during this year. So we have a poll question coming up here. In the 2020, all the states were expected to adopt 3-year PMFBY arrangements. Yet a number of states left the scheme altogether. Others adopted variants of PMFBY and some adopted their own schemes. What will happen in 2021? These states return to PMFBY in 2021. Each state will continue with the same position adopted in 2020. Other states who remained in PMFBY in 2020 will follow these breakaway states in 2021. So we have the result. We have 45% of the audience thinks that each state will continue with the same position adopted in 2020. So this slide pertains to industry premium volume, and we have plotted bar graphs for past year premium volumes, and we can see the resurging graph here. The premium volume has increased substantially each year since the inception of PMFBY. First year in 17-18, it increased by around 19%. In 18-19, it increased by around 16%. Thereafter, by 12%. But this year was a bit different in terms of the overall premium. We have a pure PMFBY premium followed by some of the states, and the premium volume for that pure PMFBY is around 210 million INR. However, as Tripathi sir explained about the SSM model, we have a premium from MP and Bid district of Maharashtra of around 80,000 million INR. So in total, we have 290,000 million INR premium coming from the ambit of PMFBY. This is a 7% decrease as compared to last year premium. But considering there are many states moved out of the actual policy, this is not a substantial decrease in terms of overall premium. Also, there's a yellow box at the top, which is 14,000 million INR. It's a premium from state West Bengal and under the policy Bangla Shashya Bima Yojana. And in spite of the scheme being voluntary this year, we've seen no significant impact on the premium happening this year. Now we have a pure PMFBY and we have a SSM model. So we have two different kind of market share basis that. So this one is a pure PMFBY market share where AIC has increased from 29% to 30%. Private companies have increased from 45% to 70%. And PSUs as such is not writing direct business as of now. In the next slide, we'll see how the market share will change when we take MP and Bid into account also. So in this, this is a market share basis overall PMFBY with pure PMFBY and SSM model. So AIC share increased from 29% to 50% and private company share increased from 45 to 50%. So we can say that the market is divided equally among AIC and private companies. Now we saw that AIC has a 50% of the market share. That is forming a premium of around 140 million INR. Out of that 140 million INR, 80,000 million INR is a premium from SSM model. And out of this 80,000 million INR, 50% is retained by AIC, and the rest is shared with the other PSUs as a co-insurance. So Oriental is sharing the 50% portion of it. Oriental is retaining 10% of it, United having 10%, National having 15%, and New India having 15% of that share. Now we have a poll question number 2. So we have spoken so much about the SSM model. So we wanted to understand the audience view on this. Assuming the SSM model continues in 2021, what should be the ideal structure for surplus loss sharing model? Existing 80-110 structure is appropriate. The swing either side of the TLR must balance, assuming an 85% TLR. Proposed structure would be 60/110, that is 25% either side, or 70-110, 15% either side, or co-sharing of the profits between state and insurance company below 80% of the loss ratio should be considered. So the poll is concluded, and we have 50% of the audience with the view that co-sharing of the profits between state and insurance company below 80% of the loss ratio should be considered. So now we'll move to the loss ratios. This slide, we have plotted the loss ratios for each company, which are represented by the alphabets below. Also mentioned there is the category for each insurance company, and the square dots representing the loss ratios from 2016 to 2019, and the blue line represent the weighted average loss ratios for all 4 years. So we can see there are 5 PSUs. Out of that, 2 are having loss ratios well below 100%. We have large private companies which are ranging from 70 to 80% loss ratios, and we have a small private companies recording the lowest loss ratios. Now we have seen the company-wise loss ratio here. We wanted to understand how is the category performing. So we move to the next slide where we have the category-wise loss ratios, and we have PSUs at 101% on a combined basis since 2016 to 2019. We have industry loss ratio as 91%. We have large private companies with 83%, mid-private with 87%, and small private having a best loss ratios of 67% on a combined basis. The only concern here is large privates having the lowest volatility and the small privates having the highest volatility in the market in terms of their overall loss ratios. Also in 2016, the overall industry loss ratio was around 79%. 17-18, it was 85. 18-19, it was 103%. And 19-20, it is around 93 plus minus 2%. So now we have seen overall the category-wise loss ratios and individual company-wise loss ratios. We would like to move forward and understand how the loss ratios has changed in terms of the states. So in the next slide, we have different states, and for each year we have plotted the loss ratios for them. We try to find out for how many years the loss ratios are more than 100 out of the last 4 years. Now in 2019, the data is only for Kharif. It's the government data, and government has only provided data for Kharif. Officially available data is only till Kharif. So in this case, we see that in Tamil Nadu is a state where 3 out of 4 years we saw the loss ratios were more than 100%. We have other states like Chhattisgarh, Haryana, Karnataka, Madhya Pradesh, and Odisha, where 2 out of 4 years we had a loss ratios of more than 100%. But Maharashtra and Uttar Pradesh having loss ratio more than 100% only once in last 4 years. And Rajasthan and Uttarakhand never has seen a loss ratio more than 100%. Now on the bottom right, we have a bar graph which is showing the combined average loss ratio for all the states. And we can see 4 states here, which is Tamil Nadu, Chhattisgarh, Haryana, and Madhya Pradesh recording loss ratios of more than 100%. So now we have seen company-wise and category-wise loss ratio and state-wise loss ratios. Here we saw some of the states having higher loss ratios over the period of time. We wanted to see how the pricing has changed for specifically these 4 states. So we move to the next slide to understand how the pricing has changed for all the states and specifically for the states where the loss ratios are higher. So here we have a table showing 2018, 2019, and 2020 Kharif premium rate for the list of states, and then we have a grand total of it. So we saw that in Kharif 18 we had a average premium rate of 14.76. In Kharif 19 it was 16.25, and in Kharif 20 it was 17.18. So we saw a change of 5.72% in Kharif 20 as compared to Kharif 19. And this increase in the rate is observed due to scheme being voluntary. Also, we had spoken in the last slide about the higher loss ratios state. So we have shown below 4 states where the rates have substantially changed. And we saw 3 out of 4 states are having higher loss ratios. And that is why the rates have adjusted as such. However, for Maharashtra, which is having lower loss ratios, combined loss ratios in the past 4 years, but in the recent year, Maharashtra has faced some losses, and that is why insurance companies want to price it that way. And hence, there's a substantial increase of around 21% in the rate of Maharashtra. Now, we've seen the overall big picture in terms of how the rates have moved in Kharif season. We also wanted to understand how the rates have moved individually and cluster wise. So we move to the next slide, where we try to plot change in rate as compared to 1920. And we want to see it cluster wise. Now, the challenge when we were doing this analysis was, we know that the cluster and district combination changes every year. So this year we found that many states, the cluster and district combination has changed. And there are only 4 major states where the cluster district combination has not changed. So these states are Haryana, Odisha, Rajasthan, and Uttarakhand. If we compare the realized rate with the last year, we see that in Haryana, all 3 clusters having substantially higher premium rate as compared to last year. Out of the 3 clusters in Odisha, out of the 6 clusters in Odisha, 3 have resulted in increasing realized rate as compared to last year. However, Rajasthan, which has recorded a very good loss ratios in the past few years, and is well below, is around 80% in terms of its loss ratio. We see that 4 clusters have seen increasing trend in terms of its realized rate out of the 10 clusters. And same trend is seen in Uttarakhand, that there are 2 clusters having substantially, one cluster having substantially higher realized rate, and the other one is having increasing trend in terms of its realized rate. So now we have 1 state missing out of it, missing from these states, which is MP, and MP is following a different model. And that is why we come to the next slide, where we have done the pricing analysis for MP. So over to you, Dr. Panda.
Thank you, Shubham. Hello to everyone. As in the last slide, we have discussed how the change in pricing in different states like Odisha, Haryana, Rajasthan, and Uttarakhand. Here, as Madhya Pradesh is having a different model, we have analyzed the rate in a different slide. So you can see that they are following the 80-110 surplus model from this Kharif 2020 season. And in this case, any claim exceeding 110% has to be borne by state government, and surplus in excess of 20% would be refunded. You can see that there are 11 number of clusters in Madhya Pradesh, and you can see the graph on the top of the slide. Here we have plotted the tender rate. You can see the tender rate in 2019-20, and you can also see the tender rate in 2021. In all the clusters, the rate is increased substantially. In the bottom of the slide, you can see that out of these 11 clusters, in 8 clusters, the realized rate has been increased. And in remaining 3 clusters, the realized rate it changed. Of course, there is a slight decrease, but there is a very marginal decrease in the rate. So in a nutshell, you can say that the rate has overall increased. So as there is a market perception that as there is a loss gap in this model, surplus loss sharing model, so the rate might have decreased. But instead of that, we observed that the rate has increased substantially in the state of Maharashtra, despite of a loss gap. So here we have identified some districts having high exposure. In fact, we have identified top 20 districts, and we have plotted this in a descending manner. And you can see that these districts are mostly from Maharashtra, Rajasthan, Odisha, and Madhya Pradesh. So you can see that top 4 premium contributing districts are from Maharashtra. In fact, bid, which is following circular loss sharing model, is contributes almost 4.34%, which is upward. Of course, this is from Kharif season. Here you can see the India graph, and we have plotted these 20 districts. You can see that these high exposure districts are basically present in central India and western India from state like Rajasthan, and one districts from Odisha. We have compared the premium rate from these 20 districts, and you know that in India there are 740 districts. Out of these 740 districts, PMFBI is implemented in around 500 districts. You may note that out of these 500 districts, this 20 districts only contributes almost 43% of the total premium from Kharif season. So you may see the exposure concentration. Just these 20 districts contributes 43% of the total premium of the Kharif 20 season. And if you analyze the premium rate of this 20 season, you may note that for 2019, the average weighted realized premium rate is almost 21.52%. Whereas in Kharif 2020 season, from these 20 districts, the average rate increased to 23.72%. So there is the increase in rate is by almost 10%. Now in previous slides, Shubham has discussed that for a pan-India perspective, for this Kharif season, the rate has increased by 5.72%. Whereas from this slide, you can see that for these 20 districts only, the districts having high exposure, the rate have increased by 10%. So we can conclude that the substantially lower rates are quoted, the districts having less exposure, and high rates have been quoted in the districts having high exposure. So you may remember that during this revamped operation guidelines, there are three major changes happened. One is voluntary aspect of the scheme in the enrollment. Second one is this multi-year contract, and third one is there is a change in sharing of the subsidy from the central government. You may note that in northeastern states they have increased the central government share up to 90%, and for other states it is remains same 50-50. Whereas they have changed, whereas they have capped the premium subsidy is up to 25% of the sum insured in irrigated districts, whereas the premium rate is capped at 30% of the sum insured in unirrigated districts. Having said that, we have calculated all the district combination in India, and we find out that in 96 crop district combination, the premium rate is more than 30%. You can see that out of this 96 crops, Tamil Nadu is having majority of the crops, where majority of the crops having more than 30% of the premium rate. Of course, these crops are more or less having very little exposure. And next is Rajasthan. Rajasthan state contributes almost, there are 13 crops which are having more than 30% premium rate. And again, Maharashtra having 16 crops where the premium rate is more than 30%. Having said that, you may note that out of the total premium of 24,610 million INR, Maharashtra contributes almost 18,149 million INR. Even 75% of the premium is coming from Maharashtra, where the crops are having more than 30% of the rate. And you may note that due to this change in the guidelines, this has a larger ramification on the state budgetary allocations, and they have certainly you can say that there is a strain on the state finances to fund this scheme. And you may note that initially Gujarat has floated for this PMAY tender, and due to high premium rate, and they have analyzed that in many crops the premium rate is more than 30%, and in that case they thought that the state share will be very much higher from that of Government of India share, which may be untenable to fund the scheme. So that's why finally they have moved out of the scheme, and now there is no crop insurance, and the state revenue department. They're just compensating the any compensating the claim from their state exchequer. And now we're having another poll question. In order to decrease the actual premium rate and to ease financial burden of states, which of the following is best suited? And the options are PMFA policy with use of technology to reduce the number of CCs, adoption of surplus loss sharing model, adoption of parametric coverage, existing PMFA scheme, and withdrawal from crop insurance and fund a disaster risk recovery scheme. So majority of the audience, they have choose the option number one, question answer number one, PMFA policy with use of technology to reduce the number of CCs. Of course, we should use more technology to have a rationalization on the premium rate. So as we have already discussed, this year there is a major change on the enrollment of the farmers and the scheme became voluntary. Here we have discussed the this proportion of loany and non-loany farmer across states which are implementing PMFA. Of course, we have included the West Bengal also. So you can see the top of the slide, we have one graph where you can see that Maharashtra, Tamil Nadu, West Bengal and Uttarakhand, Odisha, Chhattisgarh also, they're having substantial contribution from non-loany farmers. You can see that Maharashtra having 89% and Tamil Nadu Kharif almost 74%, West Bengal 43%, Uttarakhand 31%. So here you can see that in 2018, Maharashtra contributes almost 89% of the non-loany farmers. And in 2019, it increased up to 91% and 21 in 2020, there is a marginal decrease in share of the non-loany farmer. You can say almost it is same in across from 2018, 19, 20. You can see in Tamil Nadu, in 2018, the ratio of proportion of non-loany farmers is 62%, then it is 60%. Then this year, the enrollment has increased substantially. Of course, this is for Kharif season. In Odisha, there is a decrease due to they have started this integration of land record into the insured farmers. So that's why there is a decrease in Odisha. So you can see that 48% increase in non-loany policy found in Tamil Nadu. There's a decrease in Odisha due to integration of land record. And of course, in Madhya Pradesh and Haryana, there's a significant increase in the non-loany policy. Of course, the base was very small, but still uh, uh, we can see that there is a substantial increase in the non-loany policies. And basically, the impact of digitization of land records, Aadhaar linking, late cut-off date, and past loss ratio. These are few factors which impact the enrollment of non-loany farmers. Having said that, we can find out that there is no substantial increase in the non-loany farmer, and of course, so there is no substantial decrease in the enrollment of loany farmers. So more or less, there is no major impact, and the both loany and non-loany proportion remain same. So here, this is the slide having the monsoon update, and in India, the monsoon season is for 4 months. It starts from June and end in September. So this year, we have received excess rainfall in India, and there is almost we have received almost 9% excess than that of LPA long period average. And we may note that in 2019 also there is excess rainfall. I think almost 9%. So both the year 19 and 20 were receiving excess rainfall. And here we found that this year the spread of rainfall is good. And in June, you can see that there is a 18% excess rainfall. In July, there is a deficit rainfall by 10%. August, there is again surplus rainfall, and September there is also surplus rainfall. And you can see that majority of the districts having a good rainfall, except few northern states like Jammu and Kashmir, Ladakh, Punjab, Haryana, and Uttarakhand, and few states, smaller states in northeast India. And many districts of Maharashtra, Telangana, Madhya Pradesh are affected during some unseasonal rainfall event. Those are happened in the month of October. And you may aware that there are two cyclone in Tamil Nadu, Nivar and cyclone Burevi in the late 2020 and unseasonal rainfall during first week of January 2021, which caused significant damage to Rabi crop in Tamil Nadu. But overall, the crop remained good in Kharif. Next slide. Sir. Next slide. So here we have analyzed state-wise departure of rainfall from normal LPM. So you can see that in Gujarat, there is a 33% excess rainfall this year. And of course, we may highlight that Gujarat is not in the ambit of PMFA. So we may note that there is huge claims from this due to this unseasonal rainfall. Now we are getting news that this caused a severe strain to the state exchequer because they have to fund this claim from their own resources. So now they're planning, they may come back to the PMFA fold again from 2021. And due to excess rainfall is in Karnataka and Maharashtra, there are few claims are reported, and there are, of course, there are damage to the crops. And in Madhya Pradesh, the crops are substantially damaged, and we are expecting a sizable claim from Madhya Pradesh due to unseasonal rainfall. You may note that in Haryana, there is a deficit rainfall, and it's by 20%. So basically, crops like cottons are badly affected by this deficit rainfall, and we're expecting sizable claim from Haryana also for this Kharif season. And as you have discussed, there are two cyclones that hit Tamil Nadu coast, and due to this cyclone and unseasonal rainfall in this early part of January, we're expecting substantial amount of losses in Tamil Nadu. So last but not the least, here you have projected from state-wise expected loss for Kharif 2020 season. And these are all projected loss. And you can see that Maharashtra, of course, which contributes a major share of the premium for Kharif season, almost for 54,000 INR million. We're expecting that the losses will be around 50 to 60%. You may note that Maharashtra contributes almost 25% of the premium, Kharif premium, which we are expecting that losses will be around 50 to 60%. Next, Madhya Pradesh. This contributes almost 20% of the premium, and as you have already discussed, due to some unseasonal rainfall which happened in the month of October, we are expecting bad results from Maharashtra. And of course, there is a surplus loss sharing model, so we are expecting the losses to maybe around 105 to 110% for Kharif season only. In Rajasthan, there is a few districts, there is a deficit rainfall, few districts there are excess rainfall. So we are expecting around 80 to 90%. Of course, this is only for Kharif season. Karnataka, it is so the result we are expecting around 80 to 90%. Odisha, Chhattisgarh, both the states are doing good. Haryana, as I have discussed earlier, due to deficit rainfall, we are expecting some claims from crops like cotton. So loss ratio is around 110 to 120%. Uttar Pradesh having good result. Again, Tamil Nadu Kharif, there are in Kharif season, few districts that are affected due to drought. So the losses are higher from Tamil Nadu. And Assam, Uttarakhand, Himachal having the exposure is very less. So as a whole, from Kharif 2020 season, we expect the loss ratio to be around 79%. Of course, there may be 5% up and down, but overall losses will be 79%. Again, I am to say that Madhya Pradesh having SSM model, and if we exclude this claim of Madhya Pradesh, which is having a substantial premium and claim, then the loss ratio for Kharif will be somewhere around 70%. So there is a 10% gap. If we include Madhya Pradesh, it is around 79%. Of course, there is a variation of 5%. If we exclude, then it will be around 70%. Next slide. we have another poll question. Assuming a national scheme survives, what is your view on the future of crop insurance in India? The options are shift from yield-based to indices-based scheme, technology-based scheme like pilot rolled out by West Bengal government, current mix of PMFY and RWCS to continue. So I think we got majority of the answers, and majority of the audience say that the current mix of PMFY and RWCS to continue. Thank you. Thank you for the answer. I think now we'll start the Q&A session. Over to Nithya. Thank you.
Thank you, Dr. Panda. Thanks a lot, Tripathi sir, for your valuable insights. Thanks, Shubham and Dr. Panda, for sharing the analysis with all of us. We have received very few questions so far. So, because we have the benefit of having Mr. Tripathi with us and also our colleague Simon Ellis from Carpenter, London, we would request if there are any more questions, please do feel free to type in or raise your hand and we will unmute your line and make it interactive. So the questions we have received so far are, I'll take up the two questions. The first one is, putting smaller loss ratio target is another way to reduce rates. It's probably more a comment than a question. So, Tripathi sir,
yes,
how would you react to it? Yeah.
if you are mentioning that this loss ratio is a part of the overall PMFPY scheme and the state government and the central governments are agreeable, yes, I'm very sure rates will come down. Because it's a question of capping the overall loss ratio and the loss payments from the companies to the farmers. Let us say that if you reduce it from the 150% to 110%, beyond which the sharing comes into picture and the companies are not liable, definitely the rates will come down.
Thank you, sir. We have another question around the estimated loss ratios for the Rabi season. Are there any loss ratio estimates for the Rabi season in 2020?
No, not yet. Not yet. And Rabi harvesting will be starting in another 1.5 months' time. We haven't had any information of adverse weather conditions, particularly from hailstorms or unseasonal rains in the North India belt, which primarily grows wheat. And as of now, we have not heard anything, but it will be early for us to put any kind of guess to the estimates.
Thank you, sir. Niladri, if you could promote Thomas Hines as panelist. He had a question. Probably he can ask that live.
So I have promoted Mr. Thomas Hines as a panelist. You can speak.
Thank you. Thomas, you can speak now. You're live. So if you could want to ask your question.
Please unmute yourself, Mr. Thomas. Can you hear us?
Hi, Thomas. You're on mute, by the way.
We were invited on the questionnaire to give our opinion on the Maharashtra rate when they are excess of 30%. I'm wondering, why can we, in those states where actuarially the rates are so high, why can we not offer lower rates in conjunction with lower threshold yields to reduce the coverage, to bring, to make it more affordable for the states to pay for the premium? Why is that not an option? Or is it?
So Thomas, as of now, we have a standard definition under PMFBY to have the threshold yield, but then that is an option where the benefit will not be transferred. What should be there in the overall PMFBY. So the benefit in terms of the ground level will definitely reduce, but that is definitely an option and government can look at it and it can be an option to go ahead with it.
Okay, thank you.
Yeah.
Thanks, Thomas. We have a question from Amrita Bare. Hi, Amrita. What is the view of the growth on the non-loany business?
Hi,
Tripathi sir,
Amitabh.
any
Yeah, Dr. Panda, you can take it.
The party sir is there?
yes, he's there.
Yes, yes, I'm very
Yes,
much
sir.
there.
Yeah.
You want me to take it?
Yes,
Sure.
sir.
The growth in the non-only farmer this year has been much more than what was expected despite the pandemic. It was so because if you see the growth in those states which have actually benefited in the earlier years from the crop insurance program, and despite the initial fear that non-loany farmers will not come to the scheme overall, the growth this year particularly has been very encouraging, and we expect that. And some of the, if you see the states where it has increased like Maharashtra and others, it is primarily because of the losses they experienced in the year Kharif 19. That is the previous past year, 2 years past. So the growth is going to be there for the larger states where farmers have benefited, and this trend is going to continue.
Thank you, sir. So we have a question from Andrea Shi to you. Andrea, you can ask your question.
Hi, Mr.
You need to unmute yourself, Andrea.
Yeah, there she
Yes.
is.
Can you hear me?
Yes, yes.
Yep, we can hear you.
All right. It's very nice to see everyone here. And thank
Yes,
you very
yes.
much, Mr. Tripathi.
Thank you. And welcome, welcome to the Biden era.
Yes, I appreciate your very well summarized comments there. Just a very quick question on your comment regarding to the eliminating or reducing the physical CCE practice moving forward. Would you please elaborate a little bit more on that?
Sure. As I understand, during the last couple of years, the central government has actually taken the help of 10 to 12 vendors to see what kind of satellite-based images or NDVI images can help to assess the yield more accurately and eliminate the physical CCs altogether. The whole issue on this scientific approach is that the ground truthing should be perfectly correct, and it should stand the rule of the law, that on this basis this kind of assessments are correct. I believe such outcomes of these tests are now being looked into closely, and we are aiming at the launch of such assessment procedures in next 2 to 3 years. This will significantly reduce the physical testing process, and will also eliminate the moral hazard associated with estimating crop yield.
Thanks.
Thank you.
I just by this chance, I have another question for Dr. Panda regarding to the factors that you mentioned about long-only participation in the PMFBY scheme. And one of the factors you mentioned is about the digital land ID. Will you please explain a little bit more, such as, is that a positive factor or negative factor? What are the states has a better digital land IDs versus the others?
Thank you, Andrea, for the questions. Now there is a Government of India project, that is a central government project, in which they are digitizing all the land across the states. So among all the states at present, Maharashtra and Odisha, they are successfully able to digitize their all the land, and now they are integrating all the land records with the PMFBY accounts. So suppose if you are going for enrolling in the PMFBY, so you have to enroll, you have to link your land records with your insurance. Earlier, what happened? There are duplicacy in insurance. There are some frauds. So this is definitely we can say that this is a positive move. Of course, the enrollment will decrease, may decrease for short period of time, but if we'll see, this is a very good step for the future of the scheme, because by this we are avoiding the moral hazard, and and uh, and we are ensuring the actual land.
Thank you.
Thanks, Andrea. Simon, any concluding thoughts from your side?
Yes, absolutely. Whilst we have the benefit of Mr. Tripathi and the reinsurers, I just wanted to say how encouraged, Mr. Tripathi, I was with your comments about, and looking at the thing very big picture, about the future of the scheme. I think we all recognize that right now in at the beginning of 2021, we do to an extent stand at a bit of a pivotal moment with the scheme. We have seen Maharashtra withdraw from their 3-year arrangement. We've seen a number of states exit the scheme. We've seen states adopt a slightly modified version of PMFBY. And of course, we've seen West Bengal go on their own, with a more technologically based scheme than the PMFBY scheme. So it is encouraging what you say about the future of the scheme. I'm encouraged that a number of states will come back to PMFBY going forward. And it's interesting, certainly one of the poll questions that we asked would suggest that the bulk of the reinsurers actually agree with you on that, which is terrific. But I guess I just have one sort of thought, and that is clearly, government budgets have been quite stressed by the pandemic. And that's obviously true at the state government level and also at central government level. And it's certainly true here in the UK. I mean, goodness me, the pandemic certainly cost us an enormous amount of money. I guess, just one sort of concluding thought. The central government clearly remain committed to the scheme, but maybe you could just comment, just from your perspective, how committed the state governments will remain to the scheme, given the importance that they clearly have in making the whole thing work. Because I think their commitment is key to ensuring that PMFBY goes forward, which is clearly what we all want.
Thanks, Simon. I have no doubt that the state governments are equally committed, like the central government, to see that there is some sort of an insurance arrangement for the farmers. We have been associated with crop insurance in India since 1985, that is GIC. And we have seen that once implemented in a particular state, it is extremely difficult to withdraw it fully. It continues to remain there in one shape or the another. There is some tinkering with the subsidy. There is some tinkering with the sharing or pricing or coverage of crops. But crop insurance per se remains. Major states in India, let us say Rajasthan, MP, Maharashtra, Gujarat, remain committed to the scheme, come what may. The interest of Maharashtra government this year purely arises from the fact of the rise in premium rates, plus the extra stress because of the pandemic, for which Maharashtra suffered a lot. But the state of MP has found a way to continue with the scheme in some form. Rajasthan is continuing with the original PMFBY. Gujarat, we expect to come back to the scheme, the fold of the scheme in the summer of 2021. And all the other smaller states also, in one way or the other, will be coming back to the scheme's fold in one form or the other. Whether the current structure remains in its form or there is some sort of larger sharing in a co-insurance pattern or between the state and the implementing company in a particular province, that remains to be seen. But I believe during this 1 to 2 years, reinsurers are also geared up to provide different kind of support if there is any kind of need. Maybe they are on the sidelines at this point of time because of the implementation. This is the first year of this implementation of in Maharashtra, in MP and Tamil Nadu. But going ahead, reinsurers will definitely be playing another big role in the overall crop insurance schemes in India. And I have no doubt that both the center and state together will take it forward. There is, from commitment point of view, there is absolutely no dearth of interest from either state or central. State governments are equally interested in implementation of scientific measures for crop cutting experiments. That is our understanding, and we remain engaged with all stakeholders in this program, and are of this strong believer that PMAPY will branch out to larger states and cover larger areas in this country in the years ahead. I remain absolutely optimistic.
Fantastic. Well, I don't think we could sort of possibly leave this webinar on a better note, frankly, Mr. Tripathi. So thank you very much for your comments. I really do appreciate that. It's clearly, speaking for myself, it has been a bit of a concern, from looking in from the UK, about the future of the scheme, given all the changes that we've seen in 2020. So thank you very much for sharing that. I really appreciate that. And well done to Shubham and to Dr. Panda. I think it's a very good presentation. I think we can safely say that we can share it with reinsurers as required. Yes. Happy to do that.
Yes.
Thank you, Simon. Definitely we can do that. Yeah.
Okay. And
thank you.
Thank you to the Marsh team and to Mr. Tripathi. I think it's been a very worthwhile hour.
Thanks, everyone.
Thank you, Tripathi sir, for your time.
Thank you.
Thank you again to all the reinsurers who have made time in the busy rendezvous to join us. And we are always thankful for your continued support to the Indian market. And we hope to keep demystifying the ground situation for you in a better manner, so you can continue to support us. So thanks again, and everyone have a very wonderful evening. Thank you.
Thank you.
Thank you.
Thank you. Bye-bye.
Bye-bye. Bye.